Would you like an opinion on a financial matter you're dealing with? Whether it's about retirement, investments, taxes, or 401ks, Scott Hansen and Pat McClain would like to help you by answering your call. To join Allworth's Money Matters, call now at 833-99-WORTH. That's 833-99-WORTH.
Welcome to Allworth's Money Matters. I'm Scott Hansen.
I'm Pat McClain.
Glad you're here with us as we talk about financial matters. Both myself and my co-host, we're both financial advisors, certified financial planner, chartered financial consultant. We help people throughout the week as they plan their finances and also do this program to help you with your finances as well.
Yes.
So whether you have financial advisors you work with now or you complete do-it-yourself person or anywhere in between, or you're just getting started, we're glad that you are tuning in, and we hope to be a resource for you and answer questions if you'd like to be part of the program and call us as well. So that's...
You're welcome to join us. And I'm going to start off. I got to tell you, Scott, I'm in a little bit of a bad mood. We received an email from a gentleman that did not want to be on our show, but wanted to kind of share his story with us. And coincidentally, so Scott and I read articles throughout the week, and we clip anything that we think may be of interest to you. And coincidentally, one of the articles that we clipped this week was called GPB Private Placements Using the Worst Tactics in Wall Street's Playbook. And this came from...
This was a...
Where did this come from?
It's investment news.
Investment news.
GPB, a private placement company, they sold $1.8 billion. This company, they said that they specialized in automotive, primarily automotive, but waste management and holdings of vehicles. And they had touched that they were going to have an 8% return to their investors. Was that what it was in here? Yeah, 8%. Annual yields, promised annual yields of 8%. And they said the distributions would all come from earnings, not any of their principal. But it turns out they're thinking it's just a big Ponzi scheme now.
$1.8 billion. So how does this relate to you? Can you read a little bit of the email from the...
Well, first of all, if you've listened to this program of any length of time, you'll know that we are not big fans of private placements, which is something that typically are sold by brokers.
Yes.
They pay high commissions to the brokers.
They have almost no visibility.
They're really easy to get in and into and very difficult to get out of.
They are not transparent at all. And oftentimes, because of the lack of transparency, you don't know where the money ends up. And so the shtick, the spiel that brokers, salespeople are using is don't expose yourself to stock market risk. That's what they're telling you. That same spiel they sell with the index annuities. Don't expose yourself to stock market risk. As if money will just fall from the heavens upon you because you chose a different asset class than the stock market. It doesn't work that way. It does not work that way. In fact, if you look at the approximate 18 asset classes you can invest in, you can get all of those asset classes with liquidity, which means they price on a daily basis.
Any asset you can imagine.
You could get rid of them, anything. Music titles.
You want to invest in automotive like what this company was pitching? You can find that.
You want to invest in waste management as they were pitching. You want to invest in art, publicly traded. You want to invest in wines. There are vehicles that can do that.
That's right.
You want to invest in royalty catalogs, right? What's a royalty catalog? So Elton John wants to monetize his future earnings off of his albums, his music collection.
Yeah, they sell them.
They sell them. In fact, my son works for a company, one of my 4 children works for a company that prices future royalties on television and movies.
Prices them.
So when they actually...
But you can buy that through a publicly traded
You
product.
can buy, it's available. You don't have to buy private placements. You don't have to buy an index annuity. You can get to the same place with complete liquidity and 100% transparency. So the reason this makes me mad, is same time we were going to talk about this, we received an email this morning, just this morning. And I think this man who's retired, he deserved more than this.
He sent this to questions at Money Matters. Listen to your show regularly and appreciate your sound advice and feedback provided to your callers. I live not far from one of your offices, and we started with an advisor close to your office in 2017, and where we placed 3 $50,000 investments in GPB, a total of around $150,000. We have watched the fair market value deteriorate with a rough value today of 50 cents on the dollar, most likely less. And for at least the last several years, there's been an increasing rumors of Ponzi-like behavior by the top brass, and just recently, the FBI have stepped in with arrest. And I've raised the concern to my advisor several times, and it was downplayed or sidestepped each time. I'm at a loss what to do. So short of just packing everything and up and firing the brokerage firm that holds my investments, not sure what my options are at this point. We've been with them for 4 years. They also take care of our family trust and taxes, and they oversee over $1 million in assets. But most of the investment vehicles they solicit and we hold are in alternative investments. We went to them for this reason, to lessen our exposure to the securities generally offered by Wall Street. And we do have some other investments in my spouse's 401k.
The objective in this was to get away from the risk.
He's 70 and fully retired.
His objective was to get away from this risk, and unknowingly, he brought on much, much more risk. Because there is no silver bullet. There is no magic investment that's going to give you stock market returns without stock market risk. It doesn't exist. Your rates of return will always be predicated upon the risk that you're willing to take in a particular vehicle, assuming that you have all access to knowable information.
That's right. Yeah.
And here he had no access to knowable information, and his advisor,
which it looks like the advisor was a registered investment advisor, not a broker, but I wondered if there's... I poked online. I didn't mention the name of the firm because I thought there's no sense going down that path.
Yes. So,
but you can get, to your point, two things here. You can get exposure to any asset class you want just through publicly traded securities of some fortune or other. And if you do things on your own, you could do your own research, build your own portfolio. If you work with an advisor that does not receive any commissions, he or she will have no financial incentive to try to sell you some product
and
it's usually this sort of garbage. It's just you.
Yes.
And then you wonder, like, what else is in this poor guy's portfolio?
Oh, so
how do you get? The thing is, you get these rarely priced, and they're very difficult to get out of. They're also expensive to hold. Typically, if you want to have them in a brokerage account, all in a statement. Usually have to pay additional costs.
Yeah.
We know, because what happens, sometimes clients come to us and like, can you help us? We've got 80 or so financial advisors, 70 or 80 financial advisors here at Allworth, typically work with people as they're nearing retirement or into retirement. And people come to us and they have these things that they bought years ago, and they say, what do I do with this? How do I get out of this?
So Scott...
and you know, the bizarre thing, Pat and I have been working together it'll be 30 years this fall.
Really?
So when we started working with Pac Bell back in the day.
Oh.
Yeah. Doing the seminars for Pac Bell back in the day. No, yeah, it was
helping people retire.
1991. And we've seen this stuff from day one. Back in the early 90s, it was the limited partnerships of the 80s that were all sold. Then
it was viaticals.
I mean,
then it were TICs, tenants in common.
Oh gosh, what happened to all that?
And now, even publicly traded things doesn't mean it's necessarily good.
No, it doesn't mean it's good.
So we talked a week or two ago about SPACs.
But Do not buy privately held private placements. Wait, all right, let me put, if your net worth is 20 million plus,
and you have a level of sophistication,
and you want to be a partner in some sort of investment. By the way, if you look at the hedge fund universe, hedge funds underperform the publicly traded markets, right? So there's no panacea there. There's no such thing as a free lunch. And frankly, if you have $20 million, you can afford to keep your life simple and avoid that kind of stuff.
Completely. But if they're sold by brokers, stay
away. The second thing, and to your point, Pat, there's no silver bullet. There's no magical investment out there. The reality is we are in an environment today where interest rates are pretty much zero. If you want to invest your money with the U.S. government for 10 years, you'll get 1.3 or 1.4%, whatever, a little more than.
Yeah.
And that rate's gone up quite a bit.
It's moved significantly in the last few months.
The feds are the ones who outright control short-term rates, and they have influence on long-term rates by their way they purchase securities in the marketplace. But interest rates are extremely low. That's reality. So if someone's, hey, look, I can go to the bank today or some financial institution and I could borrow money. I could pledge my house. I could pledge my business. I could borrow money at what? 3%?
3?
Pledge of some real estate. Let's just call
easy.
Let's call it 3%. I could borrow money at 3%.
Someone's lending you the money at 3% for 30 years.
For 30 years.
For 30 years.
So if there's an investment that says there'll be a guaranteed payment of 5%, 6%, in this case it was 8%, the question you would have to ask yourself is, why? Why can't they get cheap money like I can get cheap money?
Yes. If it is that good, if they could guarantee, they wouldn't go to the public markets. They would not have to.
They wouldn't have to.
Right.
Or if they did, they would float their own bonds. They'd be paying, quality rated companies pay 0.5 percentage point more than the government. It's about all.
So it's unfortunate in this particular situation that this retired gentleman and his assumed soon to be retired wife were trying to avoid risk by buying things that looked like they had no risk, that had promised returns. Of, in fact, I get it. So I have college age sons, and I was at my brother-in-law and sister-in-law's house for dinner, and one of their son's friends was there.
By the way,
we
didn't answer this guy's question. Go talk to a new advisor.
Oh yes.
Get a second opinion. Have someone lift up the hood, look at those holdings, and give you an honest evaluation of what you've got going on there.
Yeah.
At a minimum, get a second opinion.
This last week, I was at my brother-in-law and sister-in-law's house, and this young man was pitching me on this guaranteed 10%. And he said, Pat, what do you think?
What young man?
He was like 20-something. He was dressed nice. He said, what do you think if I came to you with a sure bet 10% deal that there's no way you could lose money? I said to him, I wouldn't even talk to you if you talked to me like that. He said, you don't think your clients would be interested in this? And I said, oh, most certainly if it existed, I think everyone would be interested in it.
Was he literally was he selling some sort of investment?
He had some sort of, I didn't get any further into it than that. Yeah,
because it started that way.
Yeah, I'm just like, don't even.
It wasn't like, here's an interesting venture, has promising opportunities.
Guaranteed 10%. Yeah. Can't lose. I'm like, that's all I need to hear. That's it. And he's like, well, aren't you interested in talking? Wouldn't your clients be interested in this? I said, absolutely not, because I don't believe that exists in this world. Guaranteed 10%. Can't lose. Come on. That's what this one sounded like. Got a great thesis behind it.
I don't know what the thesis was. Well, it turns out it sounds like it's a Ponzi scheme, which would be interesting if this turns out to be the case, because they're going to they'll claw back distributions. Like even the Bernie Madoff thing. The bankruptcy courts went and clawed back distributions, saying You didn't actually make any money. That was just stealing from Peter to pay Paul.
And they clawed back.
So I think here, like, are they going to try? Are they going to claw back these brokers for the commissions paid?
I hope.
One would certainly hope.
One would hope.
I don't know why brokers. What's wrong with people? Why do they bother selling this garbage?
Well, one or two reasons. Either
they don't know better.
That's
They're
one
inept.
reason.
I've met enough of those people in the industry.
There's one reason. The other is that they're not honest. Or maybe the combination of the two. So anyway, stay away from that stuff too.
Yeah.
And please stay away from the index annuities. We should keep an ongoing list in our office of people that come to us with illiquid products that they try to get out of. And we try to help them, but there's not a lot we can do. But the first thing you do is get all the money away from the that advisor that you can
don't
get away.
invest in something you can't get out of immediately.
Yeah, if it doesn't, unless you said your net worth is $20 million or more, and you can afford.
But even that, look, Pat, I remember, and we will take some calls here, but we're just enjoying our conversation right now. And by the way, if you want to be a part of Allworth's Money Matters, it's 833-99-WORTH. I was on a panel with Barron's. Most of you probably know what Barron's is. It's a newspaper. Actually, if you're listening to the program, you probably do. You don't need to if you have an investment advisor, a quality advisor who does work for you. But Barron's is a financial publication owned by Dow Jones and Company. And I was at a conference in San Francisco, and I was on a panel. There's two of us on a panel. It was me and this other guy. He was with one of the big Wall Street firms. And I guess we were kind of both. I don't know. They chose to have both the two of us on this particular panel. We're talking about how we do our business and stuff. And this guy, he said his average client had $50 million with him. Okay. The average client that comes to see us at Allworth has, I think, $750 to invest, something like that.
But
we have accounts.
20 million plus.
Yeah.
We have accounts that are small, but the average client.
Yeah, we have some people come to us 500 or 300 even, right?
Or 100. We try to help whoever we can.
And so here's what this guy was talking about, and he said, my clients, we use hedge funds, private equity, private placements. My typical client has 18 different investments through us.
I can't even imagine what that tax return looks like.
By the way, when you invest in something like a hedge fund or a private equity fund, what happens? You sign up, you make a commitment. Let's say you're committing $500,000 to invest. They'll say, great, we're going to use your $500,000. We're going to go look for the investment opportunities. When we find them, we will call upon you to give us some of that $500 you promised until the point when we will finally put it all to work. So what ends up happening from an administrative standpoint is you get these capital calls periodically. And maybe they occur every 6 weeks or whatnot. All of a sudden, you don't know when they're coming. Just all of a sudden, oh, by the way, in 10 days, you need to wire this dollar amount to this account. So you multiply this by several products you've got, and now your life is extremely complicated.
Yes.
Contrast that with an article I read in, I don't know, it was the Wall Street Journal. It was one of those publications. It was a political appointee. I forget what he was being. And so he had to disclose his assets. And they're always kind of strange numbers. It's never like from 1 million to 5 million. It's always like 1,247,000 to however. So his net worth was somewhere between, whatever. It was somewhere like 81 million and 120 million. He was the past, I don't know if he's president or CEO of the Chicago Futures Trading Commission. That's what his role was. Wall Street veteran on options, right? So he ran the options board, essentially. His largest holding was a total stock market index fund.
This is like
of like $30 million of the total stock market index fund. Kept his life simple. Someone who grew up, built his career in the sausage-making business of Wall Street, all these complicated products. That's what he did. He leaves, he puts everything in the total stock market index fund. And so I read that and I thought about, here's a guy, he played the game long enough to know that Look, most people cannot outperform the broad indexes. And he says, why try? I'm going to just own the broad index.
And over time,
I'm going to outperform all my peers.
Over time, right?
At least 80 or 90% of them.
Patience and persistence.
And I think about this broker, because that's what he was, a broker. Average client's $50 million. These $50 million, they're not necessarily sophisticated investors who want to get involved in all these things. You know what? They're the person who started a business. They're the person who worked for a startup that did extremely well. They're really good at their own job, their own profession. They probably sold their business.
Ended up with a pile of cash.
More cash than they'll spend in their lifetime. They're not the kind of people that are taking private jets everywhere, for the most part.
Yep. You wouldn't know them in a crowd.
You might have a friend who's got $50 million and you don't even realize.
You wouldn't know them in a crowd.
And instead of saying, let's find a plan that's going to accomplish your goals, your family's goals, all your financial needs, hopes, and wants that you've ever thought about. Instead of making their life simple so they can go live their life, they overcomplicate things with tons and tons of different types of investments.
Yes.
And for what?
To what end?
Studies show it's not going to be any more profitable doing that.
To what end?
It'll keep the broker with that relationship
busy.
Yeah. The same thing that this letter that came to us, I'm not going to mention the name, but he says, I've been with my advisor for 4 years. They oversee our family trust. They do our taxes. So it would be a complicated and big deal to just change firms.
Well, that's not a good enough reason. That isn't a good enough reason.
But that could be a reason why some of these brokers do that. And here we are at a time when the stock market, we're finally starting to see a little bit of more volatility.
Oh, finally.
And Tesla's not going up every day like it had for a while.
Yeah.
Bitcoin's gone nuts.
Crazy. I don't understand it. I kind of understand it. It's the greater fool.
Well, that's all it is. It does nothing.
Yeah.
In and of itself, it does nothing.
Yeah.
And it's extremely volatile. Within the last year, it went from 5,000 to over 50,000. So a terrible store of wealth, because there's, if you don't know, if you put your money there because you want to go buy a house in 6 months, you don't know if you don't know if it's going to be worth 5,000.
What's the underlying asset? What's it produce? What's Bitcoin produce?
Greenhouse gases for all the mining it takes, the energy.
Right. That's it. Isn't that funny?
Yeah, you've seen those stories, all the computers it takes to mine a Bitcoin. And the electricity bills are through the roof and everything else. It is an irony, isn't it?
Yeah.
It's an irony how much.
Well, I think a lot of that is actually it's used on the dark web. I get the idea of why, if I was a criminal, that you would want to use a currency that isn't controlled by a government.
Yeah, and they can't track you.
Yeah,
exactly. Find the wire.
Yeah. I mean, if you're a criminal, what a beautiful way of moving your assets around the globe at any point in time.
Anyway, we've been talking about we've started the program on. I think the hardest thing, Pat. Look, historically, every 9 months we have a 10% pullback in the stock market. It's expected. Historically, every 3 years we have roughly a 20% pullback in the stock market. It's expected, and we're at this euphoria. Feels like right now,
But this gentleman invested in 2017. Imagine what those dollars would have done in a well-diversified, simple portfolio.
Oh, that's correct.
Right? And back to the story. He was trying to get away from risk, and in doing so, exposed himself to even more risk. And that's what happens with private placements, these non-traded real estate investment trusts, these master limited partnerships that are non-traded, indexed annuities. Look, if you knew how an indexed annuity was constructed, you would recognize that there is such a large cost of giving you downside protection in the market.
That's right.
That if you had
and you have such little actually participation in the true markets.
Yeah, if you had a 50-50 portfolio, 50% stocks and 50% bonds with some traded real estate in there, you'd weather any market cycle that we've had historically and still be on the upside.
Yeah. So anyway, it's a weird time, and if you are retired or nearing retirement, it's all the more important to understand what real risk you have. And I think you said it well. It's like people are looking for an alternative to reduce risk, but in the process, actually take on more risk than they realize, and end up with some sort of product that doesn't even trade, and now it's worth 50 cents on the dollar or worse. So anyway, we're going to take a quick break. When we come back, we will take some calls. Again, to join us, 833-99-WORTH. This is Allworth's Money Matters.
Can't get enough of Allworth's Money Matters? Visit allworthfinancial.com/radio to listen to the Money Matters podcast.
Welcome back to Allworth's Money Matters. Let's head right to the phones because we jabbered on for quite a bit early on. Let's talk with Mark. Mark, you're with Allworth's Money Matters.
Hey, guys. How are you?
We're fantastic.
My name's Mark. I live out in Charleston, South Carolina. Long-time listener, actually third-time caller.
Oh, good.
Beautiful place, by the way.
I've never been. I've always wanted to go.
Absolutely gorgeous. Absolutely.
I love it.
And what a rich and varied history Charleston has. Not pretty
All right,
brutal.
Mark, what's your question?
So I got actually three questions. My first one is, I'll give you my background real quick. I'm 47 years old, divorced, 2 teenage daughters. I have about $775,000 in retirement saved, $65,000 in brokerage, and probably $30,000 in cash. I own 2 rental properties, and I'm building my primary residence right now. And my question is, with money being so cheap right now, do you think it's better to put as much down and lock in on a low rate, or put 20% down not to have PMI?
Put 20% down.
Put 20% down to not have the PMI.
If you were 27. Well, first of all, the PMI is, when you add that in, it's a pretty expensive cost.
And what happens is you can't take that PMI and amortize it over the whole cost of the loan. You have to look at it at anything over 20%. So what it does is oftentimes it will drive the cost of money over 80% up by 2 times, right? So people have a tendency to look at it and say, well, if this PMI is only $5,000 a year or $4,000, so it's not that much. But you don't look at it that way. You only look at it for any excess dollar over 80%. And that's the cost of money that's the real cost of money there. That's why if you can avoid PMI, avoid PMI.
Okay.
And not only that, given your age, if I were in your situation, I'd have a goal to have my house paid off by the time I quit working.
That's definitely a goal.
Good.
But if I had to cash out half of my brokerage account stocks for that down payment.
Sounds like, stocks are high. It's a great time to sell.
Yeah, and by the way, do you have all stocks in your retirement plan?
Yes, I do.
Okay.
100% equity. Well, yeah, 100% equity.
Okay. Yeah. And what are the values of the rental properties?
One's worth about $430,000. I owe $295 on it.
Mm-hmm.
The other one's worth about $130,000. I owe $90 on it.
And what are the interest rates on those?
3.12 on the $430,000 one, and 4.25 on the other one. I'm refinancing the other one.
Yeah.
Thank you. Yep, I would, if I had to liquidate to get to the 80% loan to value, absolutely.
You have a fairly high tolerance for risk based upon your profile, right? 100%. And I'm not saying over the next decade, it's probably going to play out very well for you. You're all in stock in your 401k, your retirement plans, and you've got a couple rentals that you have a pretty high level of debt on them, so you're betting on long-term appreciation. But it could be a rocky road between here and there.
Which is fine.
Yeah.
You will be rewarded for that.
Okay. Well, my other question is, what, and I should know the answer to this, but I don't know exactly the answer. Outside of a 401k and an IRA, what other ways to save for retirement that are tax-friendly?
Just own a total stock market index fund. Extremely tax-friendly. Because the yields on them are so low, it grows its capital appreciation. As it grows, you have the ability at some point in time, you could transfer those to your kids, and to avoid your capital gain tax. The way state laws are structured today, if you die owning them, the capital gains is forgiven. It's very tax efficient.
Okay. And then my third question is, which is, you guys get asked this a lot, when do you sell a stock? My rule of thumb is when I need it.
If you're owning an individual stock and not a mutual fund or an ETF or an index,
This is a stock.
yeah, just ask yourself, would you buy that stock today? And the answer is no, then sell it. It's not.
Okay.
It's not any more difficult than that.
I don't own any individual stocks.
I own a couple.
I own none.
I have a lot, and I'm trying to decide. I have 20 different stocks. I bought it back when the pandemic started and everything shot down, and
Yep.
now they're all doing very well,
Well,
like Tesla and Microsoft, things like that.
Yeah. Well, you're going to sell some anyway. You're going to sell some anyway.
Yeah.
So go through there, and if you're so charitably inclined, those are the ones that you would use
So
for
if the
charity.
question is, should I sell my Tesla stock to have a higher down payment or keep my Tesla stock to avoid PMI, I would absolutely say sell your Tesla stock.
You would? Okay.
100%.
I have a lot.
Yeah.
I bought Tesla when it was really, really cheap. So.
It's really, really expensive now.
Really expensive.
I'm not a market timer. I don't know how to time the market over the long term. But looking at the broad market. But sometimes you see these outliers in individual companies that either scream "I'm super cheap" or scream "Wow, I'm expensive. I don't know how I'll ever grow into my value." That's what Tesla seems to me right now.
Yeah. That's the point.
All righty.
One quick question, and I know you guys don't like it, but what's your prediction on cryptocurrencies?
Oh my.
Oh, I don't know. I'm not much of a prediction guy.
It
It might, I could see at some point in time things settle in, but all it takes is a government to say we disallow you to use that. Couldn't you see China saying we're not going to allow our citizens to hold this anymore? I mean, I think there has to be for that to truly be a fiat, for that currency to take over fiat currency. I think you're going to have to see a major disruption in our political system, like a collapse,
Yes.
like a total collapse, and then I'm not confident that that's necessarily going to be the currency of choice. Guns, maybe.
Got it.
Appreciate the call.
Got it.
Yeah.
I appreciate it. Thank you.
Thanks, Mark.
Take care.
Glad you called. 833-99-WORTH is the number.
Charleston was beautiful, though. My wife and myself and my daughter went there for 3 days. It was very nice. I enjoyed it.
Okay.
Lots of history.
Okay. I've not been. Let's talk with Bob. Bob, you're with Allworth's Money Matters.
Hi, Scott and Pat. Thanks for taking my call.
Yeah.
Love your show.
We do too. That makes something in common.
That is, oh my gosh.
God.
What's wrong with you?
I don't know.
What is wrong with you?
Joking.
And I'm really good
I'm
looking.
joking.
And everyone likes me.
I don't know about that, but
What can we do for you?
I'm about to do a remodel in my bathroom. Pretty major remodel. Two bathrooms completely redone for a significant amount of money. And I want to know, does it make more sense to sell some stock and pay the capital gains, or use my HELOC and pay the 4.99% interest rate?
What's the value of the home today?
$800.
And what do you owe on it?
I owe about $300, but I'm in the middle of a refi, consolidating two mortgages into one at 2.5. And
Great.
maybe $500 that I owe.
And how much will you owe on that after? What's
500 total will be owed.
well, I mean, I think the question would be, should I add the additional cost of the remodel onto my $500,000?
I've already added in some to the limit they'll give me the 2.5.
Got it.
if I go higher, they're gonna increase the rate. So I think I have 10 or 15 that's going to come from the refi of the two homes, and then the balance I need to figure out if I want to put it on a HELOC or if I want to sell stock.
And how much stock do you have?
Stock, I have about 170K.
And what do you have elsewhere? How much do you have in IRAs or 401ks or that?
And my wife and I combined have 1.7 in retirement accounts. We have a few rental properties.
Yeah, all right.
How old are you?
I'm 62.
I would, if I were in your situation, I would find the stocks that have done the very best for you, and sell those and finance it that way. I mean, there's a cost. There is a real cost of redoing your bathrooms, right?
Yeah. Sometimes it's your marriage.
No.
More than ever
And,
thought.
like, I get it. I mean, that money is a tool designed to help us accomplish some goals we have in our life, right? So I totally understand, like, why you might want to redo your bathroom, but just you need also to appreciate that nothing comes free. So it's going to cost you somewhere. Either you're going to pay to this point 5%.
And
You can also do a margin loan on your account.
Why would you use the most highly appreciated there, Scott?
Well, because they had the highest run up.
Yeah. Assuming that he's held them for a period of time. How long have you owned these stocks?
Anywhere from 1 to 10 years.
And the only reason it's things are so frothy right now. The euphoria.
Are you over concentrated in any of your holdings? Does one or two
Not
stocks
really.
make up? I would go with Scott here. I wouldn't be afraid to sell the stocks in this environment and just do it down. And
Is your 401k 100% invested in stocks?
Yes.
100% in stocks?
Probably. My wife is split up. So mine is actually 80-20. My wife's is 70-30.
Okay, so here's what you can do. You can replicate those positions.
I wouldn't recommend that. You're already really aggressive.
He
right
is
now at
super
62.
aggressive. At 62.
Yeah, I wouldn't.
I'd just
I'd
sell
be
the
happy
stock.
to sell the stock and get this thing paid for.
Yep.
If I were in your situation.
I'm going to go with Scott on this one.
Okay. So.
And then make sure you've got at least. Are you retired?
No, not yet.
Okay. Plan so that you've got at least 5 years worth of income outside of the stock market in your retirement plan. So when you, you're never forced to sell any stocks.
Will you be receiving a pension when you retire?
I will not. My wife will. And my wife is probably 8 years away from retirement.
All right.
Right. Yeah, it's probably
No, you're in good shape.
Yep,
I
you're
mean,
fine.
look, nothing wrong with part of the thing. I was talking to a friend of mine's redoing their bathroom right now. He said tile prices increased 30% since the pandemic because everyone's redoing their bathrooms.
Everybody, yes.
Tile, the raw tile is up 30%.
They're like, hey, let's go do a Zoom meeting
love
in my
capitalism.
bathroom. Why is the bathroom so attractive? The most attractive part of your
You
house
do
now?
spend quite a bit of time there. We all spend time in the bathroom. That's part of humanity.
All right. Well, good luck.
Another question I have is, if I do sell stock, should I, if this ends up going, it's not going to go that long. I was going to say, do I want to do it over a period of 2 years?
Look,
I wouldn't. You're talking.
If you charted the stock market the last 50 years, the run we've had has been phenomenal. That's not to say that it's not going to continue for another few years. I have no idea. But statistical probabilities
Say.
Sell stock.
Yeah, and you're not necessarily market timing. These
it's for short term. You're talking about a short term. So that's when you say the next year or two, like, heck, who knows what's going to happen next
and
year.
the
10
reason,
years from now, it'll be higher.
The reason you save these assets were to actually sell them at some point in time. Did you not?
I did this to do these kinds of things.
Well, there you go.
Okay, there
Even
we
more
go.
so. Good.
Even there,
it worked
dude,
out great.
perfect.
You planned really well financially. You've got more money than you need for the bathrooms. Perfect.
Sell the stock.
Excellent.
Pigs get fed, hogs get slaughtered.
Appreciate the call.
Yeah. Not to say you're
Thanks,
being
guys.
piggish, but
Appreciate
it's hard to be an investor. Right? It can be very challenging. So here he's had the whole plan. This is invested in that, but the stocks have done so well
that you don't want to sell them?
Historically, stocks have done about 6 percentage points above that of the rate of inflation. I wouldn't expect any higher return than that for the next 20 years.
Yeah.
I would not expect any higher return than that over the next 20 years. 833-99-WORTH will get you on Allworth's Money Matters, and we're talking with Janice. Janice, you're with Allworth's Money Matters.
Hi, how are you?
We're wonderful, thank you.
Good. I've got a question about bonds.
Okay.
All right.
I understand how bonds work, that they go in the opposite direction of interest rates. And, so if interest rates go up, bonds go down and vice versa. And I also understand that you can buy individual bonds and hold them to maturity date. And even though the value is going down in the interim, that you'll get the face value of the bond and the interest at the time that it matures. So I get all of that. But what I don't understand are investing in bond funds or ETFs, particularly when, interest rates are as low as they are right now. And with all the stimulus, isn't it likely that the interest rates will go up and that basically you're just throwing money away?
Yeah,
Am I wrong?
but the same thing's happening with the individual bonds you're holding. It doesn't make any difference. Because if you opened up a mutual fund or an ETF, it consists of individual bonds. It just, your view of the world is what's different, not how the mechanism of the bonds working.
But here's the interesting thing is, interest rates are so low right now, we need to be really careful of our bond investments. And what we call the spread, that's the difference in interest rates between government bonds and corporate bonds. That difference is like about as low as it's ever been.
And especially in high yields or junk bonds.
Right.
That spreads, it's like investors it's unbelievable.
Yes. It's
how
like the
low return they're willing to accept.
The reach for yield is so great. So how much money do you have in bonds?
Or what percentage of your portfolio?
We have probably about 50% of our portfolio in bonds.
I think the key is just to make sure that your duration is relatively short. Rather than investing, you don't want to own a bunch of 20 or 30-year bonds.
Right.
Because then
but
they can swing like crazy.
And if you were going to buy individual bonds, what individual bonds would you buy? Would you buy corporates or governments or?
I'm not sure. Actually, probably would do government, but I'd need some guidance if I were going to do that. I don't know.
So if you were to do that, you're going to get to the same place inside of a bond fund and ETF. And quite frankly, the costs are so low, it's not even worth the hassle to you. And you're going to see that fluctuation the same way you would see the fluctuation if you owned an individual bond. So if I bought a bond today for $100,000 and interest rates went up by 1%, I would expect to see a value of my bond fall, let's say to about $95,000, depending upon the duration.
Or more, or $85,000. The longer the bond is, the more you'll...
Depending upon the duration of the bond. The same thing's going to happen in my mutual fund is going to happen in a bond. It's going to show up in the statement is the same way. What the bond fund does is actually gets professional management. And it may make sense to sprinkle some corporates in that. Doesn't have necessarily be...
As long as you're broadly diversified.
As long as you're broadly diversified. And you're going to get broad diversification inside of a bond fund, which you won't get on individuals.
Okay.
And I think the reason you would own bonds today is because otherwise you earn nothing on your cash investments.
Exactly.
The feds have lowered rates to try to encourage people.
It's working. It's working. What did they try to do?
Stock price through the roof. Real estate's through the roof.
It forces people.
Commodity prices through the roof.
It forces people to move up their risk tolerance, their reach, which actually spurs the economy, which actually creates lots of bad decision making as well.
Exactly.
It really does, both at an individual and corporate level. Because you see corporations laying on debt here that they wouldn't normally lay on.
Right.
It's cheap.
It's cheap.
Yep.
All right.
I agree. Okay, well, that definitely answers my question, so I really appreciate it.
Well,
thank you. The challenge I see with individual bonds, I was having a conversation with someone just the other day. I said, the nice thing about being in this industry for a long time, I've personally experienced all these different market cycles. It's not like I've just read about them, right? I've had my own personal experience, not with both my own cash as well as with clients. And I remember things like in the financial crisis which automobile company went totally bankrupt? Was it Ford or GM? They both had to get bailed out of some degree. We had a client who had a bond in one of those that didn't get paid back on his principal. And I'm thinking, here's a AAA rated.
It was until it wasn't.
Mm-hmm.
It was. It's exactly right. So I've never been a big fan of owning individual bonds. We've always.
How about the PG&E bonds? Remember those?
Oh, wow. Yeah.
I mean,
Right.
we could go through a list. WorldCom, MCI.
Well, those are some, yeah. I mean, things that looked investment grade. So you're much better off having a broad. That's the nice thing about a mutual fund. You could have hundreds of companies in there, and if one goes south, and it's not going to have that much of an impact.
So appreciate the call.
Exactly.
Yeah. Wish you
Okay,
well, Janice.
thank you.
All right. Let's go to Texas and talk with Dennis. Dennis, you're with Allworth's Money Matters.
Hello, Pat and Scott. How are y'all?
We're wonderful.
What can we do for you?
Well, I'm pleased to be here for two reasons. First of all, I enjoy your jovial banter between you two. It's always fun for me to listen to you. And second, I'm a proud Allworth client here in Houston.
Okay.
So,
Well, thank you.
Thank you. Thank you for both.
well, yeah, believe me, I'm pleased with both for sure. So,
Well, the joyful
I'm try-
banter is just it's a guise to hide the crusty interior.
There you go. That's right. So it's fun to listen to, and it's fun and educational at the same time. So it's a good ride on the radio for sure. So the question I've got is I've traded options for a long time, and my question is this: how do you feel about using long dated call options as a small percentage of a retirement portfolio?
I actually don't know how I feel. I've never thought about it before. How long have you been trading options?
30 years. I ran an option desk for an oil company for 15 years. So I know about the instrument, and I'm just curious about your thoughts.
Yeah, I mean, I think options can work well for individuals when they're designed for risk reduction. When they're designed for speculation, that's where they don't work out. And you understand about being in the options. I mean, it's a zero-sum game.
Oh, absolutely. Yeah, it's a buyers and sellers.
Right.
No doubt about it.
Zero-sum game, plus there's the transaction cost and all that. So it's actually a little bit less than that. It's about the same. I mean, you don't go to the casinos and play blackjack. You know that over long enough, the house is going to end up winning because the odds are slightly ahead. It's the same thing in the options market if you're there trying to speculate. If it's designed to simply reduce risk, I don't have any potential. I don't have any real problem with it. And if it's something you've done over the years, you know what you're doing. And
yeah. So. Well, and it's a defined risk. You know exactly how much you're putting into it, and you're right. It's like any investment. There's some risk involved, and there's always trade-offs and so on. So,
if you're structuring them in such a way as to reduce risk, then I think.
And Dennis, and you said long calls. Why long? How long is long?
A couple of years.
And are you doing it on individual stocks or indexes?
Yes, yeah. And let me tell you specifically what happened. I was fortunate enough to buy some Apple stock in 1980 for $12. I bought 100 shares, and I'm still holding on to most of it.
What's that value? So you paid $1,200 because there's been splits and stuff. Yep. You paid $1,200. What's it worth today?
And then over the years, the stock has split 5 times. We've peeled some of that off. It's gone up. Been a great investment. We peel it off, but I had 6,000 shares in March of this year, and they have doubled since then. So that was $850,000. So we peeled off. Me and my good Allworth advisor peeled off about a third of those in the last couple of weeks. Didn't quite get the top, but we got a pretty good chunk.
That's amazing.
It's been fab. I've been really, really lucky and blessed. But what my problem is, I'm having a cake and want to eat it as well, and so I've sold these shares off, and I said, I would really like to stay exposed to this Apple stock because I like them long term, but I don't want to leave, a couple of $100,000 sitting on the shelf with that. So I said, let's just buy $25,000 worth of 2-year call options out of the money call options.
Listen, and tax law favors that.
Yes.
Tax law favors that because
now you're providing some more clarity on what you're
right. So tax law favors it because the first death of you and your spouse, you're going to receive a step up in basis, and then you could do whatever you want without any tax implications. So the call options.
And this is all in my IRA. So.
Okay,
got it.
So, but anyway, it's basically a diversification of, I bought 20 shares, which allows me to control 2,000 shares of the underlying.
Yeah.
So we'll see.
I'd be okay with it.
I feel pretty comfortable that in 2 years, Apple's going to be well above where it is now. There's a chance I can make 10 times my money on it, if it goes where I think it's going to go. So we'll see. But I always appreciate you guys' opinion.
Yeah.
Well, there will be a time, Dennis, as if you think about it, every other great American company of the last 100 years, there will be a time when that company as well will reach some sort of maturation, stagnation, and decline. It's a natural order of life.
If you look at the Dow Jones Industrial Average, there were 11 stocks that started in it. 9 of them there were railroad stocks.
Exactly.
9 out of the 11.
Right.
How many railroad stocks are in the Dow Jones now?
None that I recall. So, well, the problem is it's a psychological problem.
That's the problem with investment. And being an investor is a psychological problem.
And every time we've peeled some off or sold some, it's been a mistake.
No, it hasn't been a mistake. No, it hasn't been a mistake. It has not been a mistake.
No.
You can only make a decision. You can.
Don't beat yourself up.
Every time we look back, I go, I wonder should I have held on to that or not.
Yep.
So I used to run a trading desk when I was run the option desk in the oil company. And one of the biggest things we had to deal with was what I call the PBH syndrome, and that's paralyzed by hope. And so we often get paralyzed by hope. We go, oh man, I know this is that we stay in losing positions because we're paralyzed by the hope that it's going to come back. And so it's so I'm having one of my, do I have the cake or do I eat it as well?
You clearly understand that investing is a very emotional journey.
Absolutely.
And it depends on the cost of the call option too, right?
Oh, absolutely. Sure,
that's what drives it.
All
so
that.
I appreciate that.
Yeah, we wish you well, Dennis. We're running out of time in the program, and look, you need to make your investments. You make a decision based upon the readily available information at that time, and if it was the right decision at that time, it was the right decision. Frankly, that's how you have to look at some of these things. So, anyway, we're out of time. It's been a joy, really, to be with you this weekend, and we'll see you next week. This has been Allworth's Money Matters with Scott Hansen and Pat McClain.
This program has been brought to you by Allworth Financial, a registered investment advisory firm. Any ideas presented during this program are not intended to provide specific financial advice. You should consult your own financial advisor, tax consultant, or estate planning attorney to conduct your own due diligence.